Good morning, everybody. This is Craig Moser with Maestro Wealth Advisors. It is the 9th day of June, 2020, and I have a market brief for you. And it's going to be a little different than the ones that we've had in the past, so just bear with me if you will. Looking at what is happening in the various markets that we're in. So let's go back to January. We were at a market high right in here, right around this range right in here on the Dow Jones Industrial Average. Things were rocking and rolling. You know, low unemployment. It's hard to find an employee that didn't already have a job. You had, that makes things good for the economy. It means growth. And then we had COVID-19, which dropped this stock market, this industrial average, down about 37%. Let's see if I can make a line that'll, let you see exactly what happened here. So as this thing plummeted down, obviously a lot of fear and concern as to, can we recover from this? And from this, we get this beautiful V bottom. So if you're somebody looking at this, you go, well, it kind of was like this one. It was kind of like that one. We go down for a little bit. Hey, it's a buying opportunity, and we'll just buy these big dips down here, and we make big money. And so far, that's accurate. But the real question is, how come we see this type of recovery? So the Dow, the best is the NASDAQ because it's loaded with technology, which kind of makes sense. When people stay home, they used more technology. But as you look through this, you've got to ask that big, overwhelming question that probably is in the back of your head. Where's the money coming from? How come with massive unemployment, how come with people not going to work, how come with a lot of business failure is the equity market back where it was, and in the case of the NASDAQ, actually at all-time highs? It's hard to rationalize. So when you're looking at this stock market, this chart is running back for 5 years. So we're actually looking back here to 2015, and you can see where these market points have hit, and then these last two, and it's like it's hard to get your head around the why of the markets going up. Maybe you say everybody is encouraged that things will get better. Maybe so. But, the research that I read says the fundamentals, the actual health of a company versus this are diametrically opposed, if you will. Now, this is opinion. You can read for yourself. But when we look at what has happened, one thing is for sure. Over here, and if you haven't ever gone to the usdebtclock.org, it's a depressing thing to look at right now. So our gross domestic product last year was substantially higher than this. So we are not producing as much as we produced last year. And in addition to that, our debt load is about $26 trillion right now. When you look at the federal spending, which is what our federal government spends, the budget has ballooned up, they say, to $6.3 trillion, of which they say we will borrow 3.1. There's an actual down here. I don't know if that's actual or not. I'm not trying to get into that debate. I'm just saying that we are borrowing over $3 trillion just for this 1 year to keep our economy afloat. So what did we do? The mechanisms to create capital are pretty complex, but at the end of the day, what we really did was we simply injected a bunch of money into our economic system. So I've been going around and around with it. Why did they do that? Why didn't they let things fail? And then if you look at failures, that means people would have to go on to government assistance programs, and they probably just said, in my opinion, that, okay, rather than let people go on to government subsistence programs and get help there, why don't we just give them some help and, maybe the economy will stay stronger. I'll go with that. I don't know. But what I do know is that with the massive injection of capital, so they sent checks out, $1,200, $600, PPP. They have, through different facilities, are buying bonds like crazy. So when you look at the various markets, I'm going to do a bond market here. So here's the bond aggregate. It used to be Lehman Brothers, no more. But you can see over a 5-year window here we're just kind of going up, we're going down, we go up, and then all of a sudden you get this big spike here, followed immediately by this massive decline, and then it rallies right back up, and you go, why are we getting such massive volatility in a bond market? So again, this is mostly corporate bonds. This is basically the entire U.S. bond market in one share, if you will. And so when you're looking at this, it's because the Fed is in here buying these bonds right now. So, okay, that's all good, right? It is, except for where did they get the money? And it's back over in that other page I just showed you. They are creating capital. We print money, the Fed takes that green money and buys a debt, and then that money basically is legitimized in the system, and then it has been given to people with $1,200 checks, to corporations with PPP money, whatever else has gone through there. And there has to be a day of reckoning for this snowball. That's basically what I'm trying to tell you here. Is that coming tomorrow? No. Do you need to head for the hills and buy a bunker? Doubt it. But at some point, how do we pay that $26 trillion bill? Where does that money come from? So you've got to understand that this is not without consequences, and maybe small failures would have been easier to handle than something maybe cataclysmic at the end. So am I worried? Yes. Am I worried today? Not so much. But even short term, there are going to be winners and losers here, because when you look at the stock markets, you've got to ask yourself, why did it go back up so very much? So I did the Dow Jones down here. The S&P 500 is similar to the Dow, except for it has more technology in it. But you can see decline, recovery, decline, recovery. So this is tachycardia if you're a doctor. This is not a regular heartbeat. And we need to be concerned with the fact that these big swings in values of our stocks is trying to tell us that, things are not in a normal place. So be careful. But nonetheless, if you're an investor, you're seeing the value of your portfolio recover back. If we're trying to get sort of a line in the sand here, it'd probably be something around right here. It is a place where we might see the market settle back in. Now, I just said that. So 2975, 28, 2900 is probably a place that you might see the market pull back to, because this has been, again, a very excessive move off of a very excessive move. So in what I'm trying to get you to is that the risk is very high right now. Don't think that this stock market is normal. It's being manipulated. Interest rates. So interest rates tilt the market in either direction. If you own a bond, just as an example, and it's just an example that pays 5%, good luck. And then the stock market is the bond market is at 1%, you will get more for your bond. I have something that I put $10,000 of an investment in, it pays me $500 a year. If you take new money and try to buy another bond like that, you can only get 100. That's what I'm trying to say. One bond pays 5, the other one pays 1 in the real world today. So if I wanted to sell the one that pays 500, I can get more for it because it pays more. So the price goes up. And that's what you're seeing over here with the bond market. So when you look at the bond aggregate, you say, okay, man, that thing's pretty high right now. Or you look at treasuries, which are even a little better, and you say, huh, that went up a whole lot, didn't it? And it's not because they pay better interest or whatever reason you can come up with. It's the fact that, you know, people are trying to buy something they think is more stable and has less risk of me losing my money. So typically they buy these treasuries. So at the end of the day, what I'm trying to make you understand is stocks and bonds are supposed to act different than one another. Right now, they're kind of acting the same a little bit because of this artificial stimulus piece. Right there's the stock market, it's rallied back up. The bonds are just starting to drop off, so that's some money coming back in the stock market. But at the end of it, I'm trying to say, don't get comfortable with this because the stock and bond market are being manipulated pretty heavily to try to keep us afloat. You know, when you look at issuing all of this debt, the final outcome is that, you know, you'll have to pay more or the boat will tip over. You know, if you look at what they just injected, and I'm reading over here from a, let's see, I think this is a Forbes article. You know, they've thrown more than $6 trillion, the government and the Federal Reserve Bank, at the coronavirus crisis. It could be more. So at the end of the day, that money is going into these markets, inflating the values. Will make your hamburger cost more, will make your Chevy truck cost more, will make your healthcare cost more because, you know, when the prices go up, they typically don't recede. And with all this extra capital pushing in there, just understand inflation's coming somewhere down the road. Inflation has been going on a long time. I remember in the 90s, we looked at each other when the Dow Jones Industrial Average went to 10,000. And we were in awe of that. We could not believe that. And now, you know, we're at 27,000. So back in here somewhere was where it hit about 10,000. Let me find it for you. Right about here. You know, 1999, we broke the 10,000 in May. And so that's been rocking and rolling since then. It's an interesting world we're in. So trying to figure out what to do with your money. If you've made money by buying some of these dips, if you've made some money by buying some fallen angel stocks like say an airline or something like that, just understand that you need to now start to pay attention to that to make sure you keep that money. So as an example, Delta Airlines dropped like a stone and a big healthy bounce. This is something I doubt will go out of business. We need the airlines, and it's not just Delta. So if you work for American, you got a similar bounce. If you work for Southwest, I'm not trying to pick on them. I'm just saying that industry is sort of essential so that it went back up. Those are things that if you think they're going to go back up here anytime soon, be careful with that. The other side of it is if you stay in these bonds thinking that you're safe, the longer term bonds, at least, as the capital comes out of this perceived safe haven, these will drop some too. So nothing remains stable in the markets these days. They change with investor sentiment and the interest rates and the capital injections. This is not a normal market I'm trying to get you to. So didn't mean to be depressing, but I'm more nervous now than I was a month and a half ago, honestly, because, you know, I'm afraid that people are thinking that things are just fine, and they're not. They're not just fine. And as we get through this next quarter, starting at the end of this month, June, and you start seeing what the fundamental returns are on these companies, you'll start to understand what I'm saying. Their earnings. You know, I'm a company, I earn so much. And in the United States, we measure it a quarter. Every quarter, we say, how did we do? And whatever our revenues and our earnings per share are, we report. You know for a fact that those earnings are going to be down. So that's a fundamental thing. The other part is the sentiment part, and that's kind of what we've been running on here. We sold off our markets because nobody's going to work. They bought them back. Are we okay? This is a very dramatic upside move based on hope. Be careful, is what I'm saying. This isn't the norm. How's that? So I'm not going to keep on beating this drum, but I wanted to make you understand that the volatility you're seeing, both down and up, are excessive. We shouldn't have that type of volatility. So just be aware that when it gets overbought, when it gets oversold, you need to have some way to protect yourself on the down and participate some on the up. And that's how we tend to manage our assets as a group. So please be careful at this point and don't get optimistic that we're going to see new highs in every market, because it very, very easily could go back down. We had that in 08. When you look at the S&P 500 back in 08, we had bumps. You can't see it as well with this, but for example, right here, we're looking back in the clock and saying, okay, the stock market made a high similar to this one, had a pretty expansive decline, just like this one, and then it rallied back up. So if I can sort of get that rally point right there, it rallied back up May and June. I'm not trying to scare you, but then it dropped back down again because it's trying. But will it succeed going up? So I don't want to stay with this all day and bore you to tears. I'm just kind of giving you a little bit of caution to make sure that you don't just feel like it's an all clear sign. We're trying very hard to recover this market. Hopefully it will. And from that, I'll just let you go for today. I hope that I've helped a little bit and not made you too nervous about it. But I want you to understand that these excessive highs off of massive bottoms could go and reverse around. So that's my little spiel for the day. I hope that you understand what I'm trying to do is let you have some caution and pay a lot of attention, because this is money that probably is taking you a long time to save, and you need to be careful with it. And I bid you a good month here in June, and I hope that we have clear skies ahead of us. And my warning is just that, a warning. And thank you.